From achieving millionaire status at only 30 years old and needing only 24 more years of his life to add 3 more zeros to his net worth and becoming a billionaire at 56 years old, the Oracle of Omaha truly deserves his name. Fast forward now in 2023, he's now the 6th world's richest man, and his fortune keeps on getting bigger every year. This is the story of how Warren Buffett went from 2 cents to $121.8 billion. Warren Edward Buffett came into the world on August 30th, 1930, right in the heart of Omaha, Nebraska. He's got some pretty impressive genes in the business world because his dad, Howard Buffett, was himself a businessman, which surely had a big influence on young Warren in his learning process, especially in the business department. The day little Buffett was born, things were in a real financial crisis. It's still considered to be the worst of all till this day.
It was panic. 16.5 million shares of stock sold in a single day.
The stock market buckled and crashed, and the nation's economy plummeted into the Depression. By 1932, nearly 1 man out of 4 was unemployed. New York, the richest city in the richest country in the world, found itself bankrupt, politically as well as economically.
You'd think being born in the midst of all that financial chaos would be an issue, right? But Buffett didn't see it that way. According to him, if he had been born during a time of economic smooth sailing, he might not have gotten all the success he has today, because growing up surrounded by all that money mayhem gave him a one-of-a-kind education in how money moves. He was taught pretty young by his dad that he needed to make money by himself if he wanted to stand out from the crowd, and he didn't waste any time to execute on his vision. Indeed, a few years later, in 1936, at only 6 years old, little Buffett had already realized that he owned the most important asset that any investor or businessman is looking for: time. At only 6 years old, he had his first taste of money when he made a whopping 2 cents by buying gums from his grandfather and reselling by door-to-door sales for a profit. Perhaps this 2 cents seems banal to you, but for him, this was proof that he could achieve great, and his ambitions was enormously high, because later he will mention that if he could not become a millionaire before 35 years old, he would drop from the highest building in Omaha. It is with this 2 cents that his adventure begins. In 1937, Buffett decided to switch from gum to Coca-Cola for a higher profit. His profit margin will increase from 2 cents to 5 cents per half dozen sold. Warren Buffett's intelligence was felt from an early age. A fun hustle he remembered doing with his friends at the time was to take note of every single plate number of the cars passing through the only road which was leading to the bank in Omaha. This was a simple yet wise move by these friends at the time, because they figured that if one day the bank would get stolen, he and his friends would have crucial information for the police who could offer them a big prize in cash. Still, 7 years old, he spent most of his time in the local library where he smoothed on topics to deepen his knowledge in the field of investment, but had never yet tried his luck in the stock market. One day, he came across a book called 1,000 Ways to Make $1,000 by author Francis Minnicker. And it was the perfect opportunity for him because he was exactly at that stage the knowledge of the book was targeting. One thing Warren Buffett remembers from this book is the famous quote, "You cannot succeed until you start." That was the point where he knew he needed to make a move for him to get ahead of most people, and that his gum reselling would not be the most profitable thing ever. It is with this quote that starts his journey to become the world's largest investor of all time. In 1951 was the starting point of what Warren Buffett is still known today. At only 10 years old, Warren Buffett invested his first dollar into the stock market. With all the various hustles between the ages of 0 to 6 years old, Buffett had accumulated $120 to his savings. You're probably telling yourself that $120 is not that much, but keep in mind that we're in the mid-40s, and that would be worth around $2,200 with inflation to this date, an impressive amount for a 10-year-old kid. He understands that at such a young age that the only way he'll be able to obtain the success he always wanted was with compound interest. At 10 years old, he realized that if you don't find a way to make money while you sleep, you'll work your entire life, and he didn't want that lifestyle at all. He stated various times, Albert Einstein, who said that the compound interest was the 8th wonder of the world. That is why in 1942, at 10 years old, Warren Buffett bought his first stock, a company in the oil business called City Service. With $120 to his name, buying only 3 shares of this company cost him almost his entire hard-working money, because at this time the stock price was around $38 per share for a total of $114.70 for all 3 shares. His excitement of his first move in the stock market wouldn't last for long because the stock dropped down good time after a few days. He continued to trust in himself, and eventually after a few months, the stock was up more than his initial investment, allowing him to make a $5 profit. Without any hesitation, he immediately took out all of his 3 shares and sold it for a profit of $5. That was surprisingly his first mistake, because it didn't take long for Citi's service to skyrocket to $202 for each share, missing out on $492 profit, which is a 400% increase of his $120 hard-working money he took 6 years to save. At least this mistake taught him 2 great lessons. 1, don't rush for small profits when you trust the company from a long-term perspective, and 2, ignore at which price you bought a stock. Focus on its valuation. In 1944, his family and he went from Omaha to D.C., Washington. He didn't like it there, but that did not stop him on his journey to make money. What Warren Buffett liked with his door-to-door selling business was his freedom of being his own boss. That's why he evolved even more at 12 years old in Washington, D.C. He started to deliver newspapers to the locals. He stated in an interview that he was delivering 500 papers a day, which made him each a penny, and with his hard work and dedication with this new side hustle combined with the fluctuations of his investments, was enough to earn him his first 4-digit amount of money. At 12 years old, he had $1,000 in all of his investments combined, which would be worth around $15,000 in today's economy. 1944 was also the first year Buffett used the knowledge of his parents in business to do his first tax return, in which he deducted his newspaper business expense of his bike and wristwatch. For his first business year ever, Buffett paid a total of $7 in taxes for the year. Not bad at all. During his time in newspaper distribution, he was able to amass a sum of $2,000 at an age of 15. He decided to make a risky investment, putting 60% of his net worth in a 40-acre farm in Nebraska for $1,200. His plan was not quite to become a farmer himself. That's why he shared profits with a local farmer who had to do the labor jobs for him for a part of the profits. Just imagine being at this place of this man doing all the manual labor hard jobs for a 15-year-old kid. 5 years later, Warren Buffett saw an opportunity in the market and decided to sell the farm for $2,000, making him a profit of $800, and that's not including profits he made with the farm itself. Satisfied with the progression of his business, he continued the newspaper's distribution till he was 16 years old and was able to make $175 per week during his best weeks at a time. To put that into perspective, the average salary in 1948 was about $3,500 a year, so Warren Buffett was making 2.4 times the average salary while he was still in high school. Remember that book from 1,000 Ways to Make $1,000? In this book was a business idea about buying a scale and having people pay if they want to weigh themselves. What stood out for Buffett for this business idea was not the idea itself, but the method of this business model, which he found genius. He found genius that he could pay one time a fee for something that would make him money whenever he wants to. He could then reinvest all the money he made with this to buy more and more without any limits. It was at this time he had the brilliant idea to invest in a new side hustle with his good friend at the time, Don Danley. He was doing compound interest business before even investing in the stock market. Their business consisted of buying cheap pinball machines that needed repairs, which Don was in charge of repairing. For instance, the difference between a cheap machine which needed to be repaired and a new one was $275. So it was again a great move by Warren to leverage other people to make him money. After all the reparations, they would place them in busy barbershops and the profits would be split by the barber. Like the scale example in the book 1,000 Ways to Make $1,000, the Buffett and Danley business quickly expanded over time because they kept reinvesting the profit they made. After a while, Buffett was able to sell this business for $1,200. In 1949, the vast majority of his wealth was made through selling newspapers and his latest pinball machines business. At this time, the stock market was only something he was investing in for the best, but at 19 years old, this was about to change. Benjamin Graham published in 1949 his book The Intelligent Investor, which is considered still to this date like the book about investing that helped the most Warren Buffett in his career. Buffett knew that this book had to have valuable insight because of the fund M. Graham, the Graham-Newman, was consistently outperforming the Dow every single year. 3 things stand out from this book that helped him on his journey as an investor. First, you need to see a stock as a piece of a company. You're not investing in the stock market, you're investing into the real value of the company. Second, a true investor is not affected by the fluctuations of Mr. Market. And third, price and value are 2 different things. The price doesn't always reflect the value of a stock. Sometimes it can be undervalued and sometimes it can be overvalued.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
Reading and studying this book helped him regain his passion for investment. He kept in mind all this crucial information for a future move in the market, because for the moment, it was time for Buffett to undertake his university studies. In 1950, Warren Buffett was now 20 years old, and it was now time for him to go to university. His father, who cared about his career and his future as a future businessman, decided to register Buffett to the world's most renowned university, Harvard. Unfortunately, they refused him. Buffett was not the most studious student, because he took his newspaper distribution business more seriously than school at the time. But when he saw that Benjamin Graham was a teacher at Columbia Business School, Buffett's approach to school would completely change. He will then make a request as soon as possible, and he will be accepted, even if his request had arrived late compared to the others. At his first introductory course, having its name Investment Management and Finance, Buffett had already read the necessary book at the beginning of the course, which was the book of Benjamin Graham and David Dodd, Security Analysis, which will impress David Dodd, who was his teacher for this course. Buffett was already under the astonished eye of two of his favorite authors, David Dodd and Benjamin Graham, on his first day of school. Benjamin Graham is known to be the father of value investing, and he taught that subject in his class, which Warren Buffett still uses to this day. This strategy consists of deriving the intrinsic value of a common stock independent of its market price. By using a company's factors such as its assets, earnings, and dividend payouts, the intrinsic value of a stock can be found and compared to its market value. One thing that he will remember forever will be the two most important rules taught by Benjamin Graham in the field of investment. Rule number 1, never lose money, and rule number 2, never forget rule number 1. During his studies at Columbia Business School, Buffett stood out so much that during a course having a teacher, Benjamin Graham, Buffett will receive the first A+ given to a student by Mr. Graham for life. This gesture will confirm that even the greatest investor saw the talent in him, and his relationship with Benjamin Graham did not stop there, but we'll see that later in the video. While continuing his studies in 1951, something interesting happened in Buffett's journey. He found out that Graham, the person who had a big impact on his investing philosophy and learning process, was part of the board at Geico Insurance. So, one Saturday he hopped on a train and headed to Washington, D.C. When he got there, he went straight to Geico's headquarters and knocked on their door. It took a bit, but a janitor let him in. Inside, he met a guy named Lorima Davidson, who was the vice president at Geico. These two got into a deep conversation about the world of insurance, and they talked for hours. They became friends for life, and Davidson ended up leaving a big mark on Buffett's thinking. Convinced by the mentality of Davidson, he made a big decision by buying for $10,282 or 65% of his savings in Geico shares, because it was clear for him that this company was in good hands. He was right, because that share would climb 50% in a year, and he decided to sell a very large part of his purchases for a profit of about $5,000. But this is not the end of Warren Buffett's adventure with Geico, despite an intelligent move on his part. We'll talk about that later. In 1954, when Warren Buffett was 24 years old and finished with school, he was given a job by his all-time inspiration, Benjamin Graham. Graham Newman Corp was an investment firm owned by Benjamin Graham and Jerome Newman, and Mr. Graham was so impressed by Buffett's talent in his class that he offered him a job at his firm with a salary starting at $12,000. To put that into perspective, the average salary for a man in that year would be less than $5,000 a year, or translates to around $137,000 in today's economy. Buffett was also the first non-Jew person to ever work in Benjamin Graham and Jerome Newman's firm, which was quite a dream come true for Buffett, you would probably say. But not quite like it, because he had way more ambition for his future. But he accepted the offer for now just for the experience. That allowed him to boost his savings to over $100,000. Because in 1956, he retired and folded up his partnership, and the same year Graham Newman Corporation was liquidated upon Benjamin Graham's retirement. The Buffett family returns home to Omaha from Washington, D.C. on May 1st, 1956. Buffett creates Buffett Associates Limited. 7 family members and friends contribute to a total of $105,000, while Buffett invests only $100. The business followed the same formula as his mentor Benjamin Graham with Graham Newman, but he now has the owner of his own partnership and will never again work for anyone else. He is now managing the funds on behalf of a select group of sophisticated investors, following again the strategy of his trustworthy mentor Benjamin Graham. They had a strategy called the cigar butt strat. This type of strategy prioritizes cheap and unloved stocks, but at least good one for last puff, like a good old cigar butt. On a more professional side, this strategy translates to buying a cheap company with a pretty low PE ratio or at a low price compared to cash and assets. This mispricing would often correct themselves after a few months and offer investors like Mr. Graham or Buffett their last puff. They would then sell the company at a good profit and repeat the loop. In 1959, Buffett was on the lookout for companies to invest in, and he had his eye on a business called Blue Chip Stamps. It just so happened that Charlie Munger, now the vice chairman in Berkshire Hathaway, was the chairman of Blue Chip Stamps at the time. As Buffett attended the Blue Chip Stamps annual meeting, he had the opportunity to observe and listen to Charlie Munger, who was leading the proceedings. Munger's intelligence, wit, and deep understanding of business matters immediately caught Buffett's attention. Warren Buffett even called Charlie Munger a buck with legs, so much that he was impressed by his knowledge the first time he met him. Over time, their paths continued to intersect as they found themselves attending various business events and meetings. Their mutual respect and shared values gradually solidified their bond. Charlie Munger even changed Buffett's mentality when it came to investing. With Benjamin Graham's mentality, it was buying mediocre and cheap companies trading at bargain prices. But with Charlie Munger, it was buying great companies which are much more valuable at fair prices. More simply, Munger's advice was to buy wonderful companies at fair prices instead of fair companies at wonderful prices. The Munger method was much more scalable and was for investors having a little more capital to invest, which was perfect in Buffett's progress because having more and more capital with Berkshire, he could afford to make much more advanced investments. This one advice helped Berkshire to grow exponentially more over time. This encounter marked the beginning of a collaboration that would go on to have profound impact on the world of investment and business. But we'll get back to that later. In 1962, Warren Buffett officially became a millionaire, fulfilling his promise made 24 years earlier when he was 6 to jump from the tallest building in Omaha if he was not a millionaire by 35. In 1962, Warren Buffett began buying shares of Berkshire Hathaway, which was then a struggling textile manufacturing company based in Massachusetts. Initially, he started purchasing the stock because he saw it as a value investment. Buffett gradually accumulated shares of Berkshire Hathaway, considering it a classic cigar butt investment, where he saw potential for short-term gains. However, he soon realized that the company's fundamental business prospects were not as promising as he had hoped. Eventually, he gained a significant ownership stake and became one of the company's largest shareholders. By 1964, he owned about 49% of the company's shares. The management of Berkshire Hathaway proposed a tender offer to buy back shares from shareholders at a slightly higher price than the market value. Buffett agreed to the deal, selling his shares back to the company at $11.375 per share. After selling his shares, Buffett had a change of heart. He saw that management of Berkshire Hathaway intended to continue with the textile business, despite its challenges. He realized that his investment in the company was based on the premise that the textile operations could turn around, a premise that he no longer believed in. Rather than completely divesting from Berkshire Hathaway, Buffett decided to use the funds he received from the scale to acquire more shares. He started buying shares on the open market, ultimately amassing a controlling ownership stake in the company. 1965 was also a significant year for him, because that was the year that he acquired Berkshire Hathaway, and through this day, this textile company served as a vehicle for Warren and his 25 companies at a time to acquire and invest into strong companies. From that very moment in 1965, Berkshire Hathaway remained Warren Buffett's first priority. For 57 consecutive years, this businessman was consistent in coming to his office every day to evolve his business over time. He showed that the magic of compounding is real, and whatever the size of the challenge, anything is possible if consistency is part of the game. But how is he able to make himself apart from every other investor? The only reason is because he follows the same rule with his investments, so he can minimize the risk. It is the following one. In the book The Science of Hitting by Ted Williams, he explains the science of hitting the perfect shot by sewing a strike zone broken into 77 circles. Ted Williams would only hit the ball according to where it was going on in scale to increase the chance of hitting a good shot the minute he would hit it. Warren Buffett replicated his formula with investing. He said that you can look over 1,000 stocks and decide to only bat one of them, but this could be your home run. The trick in investing is to watch pitch after pitch go by and take the right opportunity where a home run is coming at you. The only difference with baseball and investing is that you only have 3 strikes in baseball, while investing, there are infinite.
In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily. Nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. If you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Combining this rule with the strategy of today's vice chairman of Berkshire Hathaway, Charlie Munger, it was nearly impossible for him to miss out on profitable opportunity in the market. He famously seeks business with a moat, meaning a sustainable competitive advantage that protects them from competition. He aims at companies like Coca-Cola, Geico, Apple, Dairy Queen, and many more. During the years at Berkshire Hathaway, the investment continued to grow. In 1967, Buffett invested around $20 million in American Express during a crisis caused by the salad oil scandal. He believed in company's strong brand and saw the stock's potential rebound. His long-term perspective paid off as the investment grew, showcasing his knack for identifying undervalued opportunities. American Express reached more than $180 per share, making the partnership $20 million in profit on a $13 million investment. 1967 was also the year where Berkshire paid out its first and only dividend of 10 cents to its shareholders. To illustrate the division between investments and production in Berkshire Hathaway, consider this. The textile operations were generating $45,000 annually, while the combination of investments, insurance, and banking was yielding $4.7 million. In other words, the primary revenue from the textile side was a mere 10,005% less than the returns from investment. To put this into perspective, adjusting for inflation, that would equate to approximately $31,514,536.08 in today's currency. This stark contrast highlights the remarkable disparity between the two revenue streams at a time. In 1972, Berkshire Hathaway faced a stock price decline due to negative market sentiment, challenges in its textile and other holdings, and microeconomic factors like inflation and recession. Buffett's personal wealth is cut by over 50% at this time. Warren Buffett's diversification strategy and long-term vision would later lead to the company's success, despite these short-term challenges. In 1985, Warren Buffett chose to shut down Berkshire Hathaway's textile business due to a combination of factors. The textile industry was struggling, facing tough competition and shifting economic conditions. The business had become unprofitable, and its prospects for growth were limited. He refuses to allow it to drain capital from shareholders. Buffett's decision was strategic. He wanted to allocate resources to more promising ventures that aligned better with his investment philosophy. By closing the textiles business, he aimed to refocus on businesses that could generate better returns and contribute to Berkshire Hathaway's long-term success. In 1986, Warren Buffett reached the milestone of becoming a billionaire at the age of just 56. Warren Buffett's investment in Coca-Cola is a testament to his long-term investment strategy. Starting in 1988, Buffett recognized Coca-Cola's enduring brand and market dominance. He acquired a substantial stake of up to 7% of Coca-Cola's worth, $1.02 billion, believing in the company's steady growth potential. It will turn out to be one of Berkshire's most lucrative investments. In 2008, Buffett became the richest person in the world, with a total net worth estimate of $62 billion, overtaking Bill Gates, who had been number one in the Forbes list for 13 consecutive years. In 2009, Gates regained the top position on the Forbes list, with Buffett shifting to second place. Both of their values dropped to $40 billion and $37 billion respectively. Buffett lost $25 billion over a 12-month period during the big crash of 2008 and 2009. That didn't stop the legendary investor from slowing the speed of his investments. Indeed, Warren Buffett took the chance to be greedy when others were fearful, like he always said. In 2009, Buffett invested $2.6 billion in Swiss Re's equity capital drive, adding to Berkshire Hathaway's existing 3% stake with a potential for over 20%. Additionally, he purchased Burlington Northern Santa Fe Corp for $34 billion in a mix of cash and stock. That shows his non-fearful and wisdom during these times of financial crises. In 2010, the Giving Pledge campaign was created. It's a philanthropic initiative created by Warren Buffett and Bill Gates, aimed at inspiring the world's wealthiest individuals and families to commit the majority of their fortunes to charitable causes. The campaign encourages signatories to publicly pledge to donate at least half of their wealth during their lifetimes or in their wills. Buffett's own generous commitment to donate a significant portion of his wealth to the Bill and Melinda Gates Foundation served as a catalyst for the campaign's creation. In 2017, he increased his investment in Apple, and it became Berkshire Hathaway's largest investment in one company's common stock. After exercising some warrants, Buffett also became Bank of America's largest shareholder, owning about 700 million shares. That takes us to 2023. Warren Buffett, being 93 years old, still continues his business with passion. From his first 2 cents made by selling gum to his $121.8 billion fortune of today, his journey proves that dedication pays off. He found his business model in 1965 and did not take a step back till this day. Warren Buffett will forever be a source of inspiration.